Hey guys, I am buying this growth monster literally since like 2004. This stock is up thousands of percent. So, again, big whoop. I only own one share, but I plan to add more to this position in the future. And this stock is actually called Monster. So, this is Monster Beverage. And there's a statistic that will very much impress you. This company has bought back 6% of the entire company just in the past year. So, stay tuned till we do some analysis on their fundamentals. But look at this right here. They are down 14% the past 3 months. And if we look at them the past year, they're down 16% the past year. And they're only up 34% the past 5 years, which, isn't even that good of a return. They've well underperformed the market the past 5 years. But historically, this one has performed incredibly. So I want to show you why I bought them. I actually bought them here in my Roth IRA. And again, it's one share, but I plan to add more in the future. I recently bought another share of InnoData and some BBW, which don't report me. This is Build-A-Bear Workshop. Somehow, this stock is up 850% the past 5 years, and I'm actually down on my position, so I just bought them. But anyway, that's our Roth IRA. Let me show you a quick analysis on Monster Beverage right here. So if we look at their sales right here, 91% of their business comes from Monster Energy, and this is why the stock has kind of not done so good the past year. The sales are only up 0.85%. So that's not good growth. If we look at their strategic brands, this is actually Bang Energy. It is up 14%, so we've seen a nice little recovery there, so that's up 14%. And they're also in, this is only 2% of the revenue, so that doesn't even matter. But this is why I like them. Look at this. They're making free cash flow every quarter. They just made $500 million of free cash flow in the most recent quarter. That's why they're doing a bunch of buybacks right now. And yeah, again, the sales are only up 1% year over year, and look what that did to the net income. The net income is down 18% year over year, but they're still making a lot of money, 370 million. And again, this company doesn't pay a dividend. So they don't owe anyone any money. And they were debt free, but they just took on debt last quarter, a little bit of debt, but it was for a good reason. And let me actually show you this right here. So here we are on the Webull app right here. Here's what's most impressive about this stock right here. So look in the top right, look at this market cap. They're worth $44 billion. So remember that number right there. The whole company's worth 44 billion right now, and look at how much this company is spending on stock buybacks. So they're never issuing shares. That's a good sign. Look at that. They do not issue shares. So they're a shareholder friendly company. Since they don't pay a dividend, they return shareholders money in the form of a share buyback. So look at this. Last quarter, they spent $3 billion buying back their own stock. And then they spent another 525 million the most recent quarter buying back their own stock as well. So right now that leaves them with only $1.65 billion of cash. So that some people are like, hey, why did their cash go down a bunch? It's because they just literally spent $3 billion on buybacks and they still have 1.63 billion of cash sitting on hand. But one thing you do want to keep in mind, and I don't love this actually, but again, they could literally pay this off in less than 2 quarters of net income or free cash flow. But look at this. They have total debt of $750 million. So again, not that much debt. They were debt free. They took on debt for a good reason. So yeah, if we go to this company's total common shares outstanding, look at this year over year. It used to be $1.04 billion of shares. Now it's 972. So that is a 6.53% reduction to the total common shares outstanding. So if they instead of doing buybacks, they spent that money on a dividend, you would have gotten the equivalent of a 6.7% dividend yield. So that just kind of shows into perspective how much they're spending on buybacks. Remember, they spent $3 billion that one quarter. The whole company is worth $44 billion. So that's kind of why I bought Monster Beverage. And I would much rather buy a Monster Beverage than a Celsius right here. So check this out right here. If we look at Celsius, this stock has not done too good, which is very unfortunate because I do like Celsius, but I just can't buy them right here. Because look at this right here. Their net income, Celsius normally makes like 50, 60 million of net income, but for some reason in the most recent quarter, it tanked to only $6 million of net income. And actually, if we look at their operating income, they actually lost money. The only reason they made net income was because they're making interest on their cash. So in reality, they lost money, but because of their positive interest, they made net income. But look at their total sales year over year. The sales declined 31% year over year. So that is why the stock has declined this much. But that being said, I believe this company has no debt. So it's not completely terrible for Celsius. Like, let me double check this for you. So look at it right here. They have a lot of cash, $903 million in cash, and they're only a $5 billion company. So wait, they're trading at like 15 to 20%. 15 to 20% of their market cap is just the cash they have on hand. So 903 million of cash. And look at this total debt of 200,000. So literally no debt, I would call that. So yeah, look at this right here. Diluted normalized DPS. It was literally zero. I've actually never seen that. They made $0 of EPS when you look at it dilutive. So yeah, check this out. Because they have no debt and a bunch of cash, it literally made them $11 million of interest just in the most recent quarter. So this could potentially be a cash play. But again, this company lost their growth, and we want to see the growth come back. And they actually lost money if it wasn't for their interest payments. So, oh yeah, look at that, a $5.27 billion company. So they're trading at 20% cash. And look at the PE ratio. This is why the stock has kind of collapsed. It has a pretty high PE ratio, even right now, 31 PE ratio. So when a high PE ratio stock, sales start to decline and net income starts to decline, you get this, insane decline. And I think Monster Beverage is partially falling because Celsius is doing so bad. And I think Monster as well, if they want to stop doing buybacks, I think they're going to buy another beverage company. They can grow the company through M&A. So that would be very cool. Maybe they could buy Celsius or something. That would be actually a very cool acquisition. So anyway, let me know your thoughts on Monster Beverage. Again, they're probably a risky company. And a lot of people are addicted to this stuff, and it's the little drinks at the gas station. So, and also I thought I should mention that Coca-Cola is the largest shareholder of Monster Beverage. They own 21% of the company. So if you own Coca-Cola stock, you technically have some exposure to Monster Beverage. So I think this one was a cool addition to my Roth IRA. Again, it's only one share. My Roth IRA is only $300. I started it less than a year ago, but I thought it was a cool addition here. I try not to, because I own so many dividend stocks here in my main taxable account right here. Yeah, look at this. Today was not great. We were down 2% on the day. That's mainly from our largest holding right here, Carlisle. They fell 9%. And Google, they fell 7% on earnings today, which is kind of weird. Meta was kind of green on the day. Meta's pretty much at an all-time high. They've done incredible. Again, like Meta and Google, they do pay dividends, but they're more of like dividend growth stocks. A lot of people don't even call Google and Meta dividend stocks. And I know this is a little off topic here, but I have something I really want to share. So you see how Google fell 7% today? They actually fell because of slowing growth. But check this out. Look at the valuation of this company, kind of in the top middle here. They're literally trading at 24 times net income, 24 times PE ratio, which is very cheap, especially for this high quality company. Like if we look at the historic PE ratio right here, it's pretty low. It's at a good valuation right now. But here's why the stock fell. If we look at their sales year over year, the sales are only up 11.77%. So they didn't like the sales growth, but look at their net income year over year. The net income is actually up 28% year over year. So what does that mean? Their margins actually just expanded by 15%. So they now have a 27% net margin. It went from 24 to 27.5. Now that may not seem like that big of a difference, but when your sales are literally 96 billion in 3 months, so literally $100 billion of sales, a 1% margin, makes you $1 billion. That's net margin as well. So net income margin. So they literally made $26 billion of net income. They now make more money than Microsoft. So Google makes more net income than Microsoft, but trades at a much lower market cap, which is kind of crazy. So look at this right here. Microsoft actually makes just a tiny bit less net income than Google. And if we look at their market cap right here and valuation, they're a $3 trillion company and they're trading at 33 times PE ratio. So Microsoft's a $3 trillion company. If we go back to Google right here, I'm guessing they're a 2.5 or $2.36 trillion company. That just seems so much lower than Microsoft. But anyway, if you found value in this video, don't forget to drop a like for me. I'd really appreciate that. If you leave a comment for me, I'll make sure to check them all out. And also, if you subscribe, I really would appreciate that. But yeah, I hope you have a great rest of your day. My name is Nathan Robert. I'll see you in the next video.